Hello, it's Eric Green again from Convisor & Percy in Glastonbury, Connecticut. And what we're going to talk about in this segment is the actual Department of Revenue Services of Connecticut DRS sales tax audit. We're going to talk about the actual audit itself. What goes on during a sales tax audit here in Connecticut? Well, what the Connecticut Department of Revenue Services is going to do, a number of things. First thing they're going to do is they're going to compare the federal tax return to the sales tax returns. Why? The federal returns are going to have a gross sales number. That, in theory, should tie to the sales tax returns. If it doesn't, there's an issue, and they're going to want to investigate that or look at that. And potentially, there's one area where they're going to look at is underreporting. All right, they're going to pull purchase information from third-party vendors. We talked about in the first segment how they're looking at liquor distributors and cigarette distributors to get that information. They're going to take that information and compare it to the sales. For instance, we've had businesses show up where the sales tax returns add up to $200,000, but supposedly they purchased $450,000. Well, that's a problem, right? Right off the bat, the Department of Revenue is going to jump all over that. They're also going to look at the cash register tapes and or the Z tapes. The Z tape is a summary tape that comes out of the newer registers. Okay, under Connecticut regulations, businesses are supposed to maintain cash register receipts. Okay, it's a little bit of an issue right now legally whether Z tapes are even going to fulfill that requirement. But you're supposed to be keeping your register tapes. If you have them, they're going to obviously look at those and compare them to the deposits and the reported sales to see if everything that's supposedly being deposited and sold is actually going through the register. They're going to review a selection of the taxable items in the store because they're going to be trying to figure out what the markup is on those taxable items so they can determine what the sales number should be, and therefore what the sales tax number is. They're also going to look at the items in the store to determine what percentage of the items sold are taxable. Not all of a business's sales, especially in the convenience store area, are taxable. Some of the items they sell are not subject to sales tax. So they're going to want to try to come up with a calculation or a percentage of how much of the sales are actually taxable. All right, they're going to compare the actual records, as I mentioned earlier, to the reported sales, looking for an understatement there. If the business does not have records, and this frequently happens with small businesses, they just don't keep good records. If the records are lacking, there is a judicial precedent. There's a court case in Connecticut that states that the Department of Revenue Services can use any method that is reasonable if the taxpayer does not have records. Therefore, very often, if you don't have records, what they're going to use, they're going to take the purchase information. They'll take all the vendors that they can find. They're going to take all the purchase information that they can get their hands on. They're going to come up with a markup, and they're going to basically give you a bill. All right, they're going to hit you for 15% negligence penalty, and there will be interest compounding at 1% per month. Okay, and now they're not going to normally for a 3-year period. They don't audit the entire 3-year period. They pick a portion of that, a few months, to audit and come up with an error rate, the difference of what they think should have been reported and what actually was. That error rate will then be applied over the entire audit period. However, if there is more than a 25% understatement, okay, that will be considered fraud. And once they believe there is fraud, there is no statute of limitations. What does that mean? Well, what that means is the auditor is going to audit the entire back to when you first acquired the business. So we've had people come in 10, 12, 14 years under the audit because of the issue of the understatement. Once they have the understatement, they're no longer limited to the 3-year period. If there's fraud, there is no statute of limitations. They can go back to the first day you bought the business, and that's exactly what they're going to do. So, go check out the other segments about dealing with the audit and the appeal that are out there. All right, as we just discussed now in handling the audit. If you need help, if you have a Department of Revenue sales tax audit going on right now and you need help, feel free to contact us, and you have our information. Thank you.